Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The trouble with the world is that the stupid are cocksure and the intelligent are full of doubt. Bertrand Russell, everything is funny as long as it's happening to somebody else. Insanity in individuals is rare, but in groups, parties, nations, and epochs, it is the rule. Democracy is the theory that the common people know what they want and deserve to get it good and hard. Democracy is the theory that the common people know what they want and deserve to get it good and hard.
Here's a quiet yet strong lesson from this chart. After the 2022 fiscal mess, the UK did not defend the pound with speeches, it let gilt yields rise. And the market did the heavy lifting. Higher yields stabilized sterling. Japan chose the opposite path. Cap, JGB yields, which is basically Japanese government bond yields, suppress price signals and watch the yen slide. Same bond math, very different outcomes. As long as the Bank of Japan keeps yields on a leash, the currency takes a hit. Markets hate caps, they respect prices. Q3 was solid, not flashy, and that's exactly why markets like it. India Incorporated delivered double-digit revenue and profit growth, helped by GST cuts and steady demand. Autos and FMCGs led the charge, banks kept ticking along, and metals behaved for once. Margins did cool a bit. Input costs are not exactly on vacation. But this was a quality quarter and not a sugar rush. Translation, earnings momentum looks sustainable, even if valuations now want proof and not promises. This chart is quietly screaming selective opportunity. Broad markets are not cheap, but pockets like insurance, housing finance, hotels, and IT-enabled services are trading well below their own history. That's not a crash signal, it's a margin of safety signal. Cycles matter. Some sectors are priced for bad news that's already happened. For patient investors, this is how opportunity usually shows up, uninvited, uncomfortable, and unfashionable. As Charlie Munger said, the big money is not in the buying or selling, but it's in the waiting. This chart tells a very Indian fiscal story. Dividends are doing the heavy lifting. Central public sector enterprise payouts keep beating budget estimates, quietly plugging revenue gaps year after year. In effect, the government is funding the budget by milking its own balance sheet. Reliable, yes, but not exactly reform-driven. That's why FY27 disinvestment targets look optimistic. If dividends are this good, selling assets becomes politically and fiscally awkward. Comfortable today, complicated tomorrow. This is the quiet elephant in the room. US external liabilities are nearing $40 trillion, net close to $30 trillion. Yet markets are oddly calm. Despite a softer dollar and fading US exceptionalism, foreigners haven't rushed for the exits. What we are seeing is hedging, not liquidation, trimming risk and not dumping assets. But history says that these shifts do not happen linearly. First comes the hedge, then comes the rethink. The real question isn't if flows turn, it's when they stop being polite. As Ernest Hemingway said, gradually, then suddenly. Here's the punchline. India-US agricultural trade is booming without a grand deal. US agri exports to India are up 34%. India's exports to the US are growing too, even after the tariff noise. The mix is clean and complementary. America sends nuts and cotton, India sends seafood, spices, rice, and processed foods. Crucially, India's red lines like dairy stay untouched. So if trade is already working, the real risk is in conflict. It's over-negotiating something that's functioning just about fine.